Well, Friday's US labour market report brought the 14th straight beat versus consensus on the non-farm payrolls number, with 339,000 jobs added to the US economy in the month of May. But a rise in unemployment did take some shine off the release and leaves the debate very much open around whether the Fed will pivot, pause or skip at the June meeting as we enter the pre-meeting blackout period this week. The dollar softened just a little bit last week. Equities continued to rally. Treasuries relatively stable. It's a busy week ahead. We've already kicked off with the Saudis announcing an extra 1 million barrel per day output cut, which is trying to put a floor under the oil market. A busy week ahead. The Reserve Bank of Australia, the Bank of Canada making policy decisions, but the market focus is already starting to look a week in the future. It's a very, very busy period ahead to kickstart June. Looking a week ahead, the US inflation data, the next Fed meeting, and the next ECB meeting. So it's another busy episode of the Trade Off UK this week. Without further ado, let's get into the show. So, plenty as always for us to discuss on this week's show. Without further ado, let's bring in my co-host, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, good morning. How are you doing? Looking forward to your big European adventure this week, are we?
Yes, morning, mate. Very much looking forward to it. Jetting out of Heathrow tomorrow morning. See what happens when we're over there. It's going to be a party either way.
Well, I'm sure it is. And speaking of Europe, I just wanted to bring this up on the front page of the City AM this morning. We are filming this on a Monday. City keeps European finance lead. Yet again, those who are betting against the City of London have seen their predictions age like milk.
Yeah, look, there's no flames behind me in this picture, so, you know, all's well. Carrying on, Brexit as normal.
Exactly that. And although we may be beating Europe in terms of trading, probably not in terms of footfall. It's like a ghost town around here at the moment. In any case, let's get into the show with Topical Thunder. So I want to talk about the Fed to get the show underway this week. As I said in the intro, the Fed's pre-meeting blackout period gets underway this week, as it always does, around 10 days before the next policy decision. So now is really as good a time as any to assess where we stand and what we're likely to get at the next FOMC in June. In terms of market pricing, we're currently at around about a 30% or 1 in 3 chance that the Fed raise rates by 25 basis points next week. But a full 25 basis point hike is priced in by the time of the July meeting. So the market is very much on board with this idea of a skip, where the Fed would remain on hold at the June meeting, give a bit of time to assess more data, and then raise rates again towards the tail end of July before they all go off on their summer break. Now, there has been a bit of a shift in language from FOMC policymakers. We heard last week Jefferson, Harker, and a few others endorsing that idea of a skip. And it's sensible. Why? The Fed have delivered around about 500 basis points or so worth of tightening over the last 12 to 15 months. And it's going to take time for that to feed through into the economy. So it's perhaps unsurprising that now we're getting into restrictive territory. Policymakers are taking a bit more of a patient approach as inflation begins to fade. Now, speaking of inflation, I think that's the key thing to bear in mind, because the day before the next Fed meeting, we have the next US CPI number, and that really could change everything. But I think it's important to look at market pricing, because we have seen a significant shift. We've gone from around about 70, 80 basis points worth of cuts being priced by year end to now I think we're sitting at around 7 or 8 basis points of cuts. So pretty much the market now has that higher for longer idea priced in. And I think that's important to consider when we look at the dollar. It has provided a little bit of a tailwind, forgive me for the greenback. And it has also, remarkably, in my mind, equities have shrugged that off very, very well indeed. And I think if we do get a pause or a skip or whatever you want to call it from the Fed in a week's time, it could be a bit of a fillip for equities. But I don't think it's going to result in too much downside for the dollar. If you consider how low market rates still are, actually, if the Fed were to pause at a meeting, it is effectively a tightening.
Yeah, it's been very strange, because in the space of last week, we came into the week, the market was pretty much pricing the 70%, 60% chance of the Fed hiking by 25 pips. And then we had this data out, we had the PMI data, which all showed softness in the price measure. I think it was the S&P Global PMI had the first contraction or the first drop in input prices it's seen in 3 years. So The market got a little bit spooked by the price components of some of the data. Like you mentioned, we had Jefferson and Harker speaking. Harker wasn't so much of a shock because he's been touting that line since February, March time, when he said if rates get to 5%, that's when he would look to hold. The difference, I think, was with Jefferson and Harker, they're both voters, whereas the likes of Mester, who were speaking more hawkishly, are not voters. They're on the alternate members. So, yeah, it completely flipped. And now we're pricing 60, 70% of a hold at the meeting. And I think you're right. I think the data is going to be important. I think that CPI data could be more important than the FOMC meeting itself, because it's going to create a lot of volatility. If inflation jumps, we're pricing a hold, it's going to flip completely on its head, and the market's going to have to do some last minute repricing on that. So it's going to be very tasty, as we like to say.
Yeah, most definitely. And I think it could be a case this week, actually, of kind of calm before the storm, where the data calendar is a little bit light when you look at the US, Europe, the UK. Apart from the ISM data, there's not really anything that kind of jumps out as a big data or event risk. So, I agree. I think next Tuesday and Wednesday are when the fireworks could start to be let off. What about down under? Because I think they're going through pretty much the same debate in Australia, aren't they?
Yeah, I thought I'd copy just a quick copy and paste of your title. Because
I like to make it easy for you, mate.
If I don't have to do much work first thing in the morning on a Monday, I don't mind that at all. But yeah, the situation we're in now with a lot of central banks is the market, trying to guess what the central banks are going to do. Are they pivoting? Are they pausing? Are they skipping rates? The RBA already paused and then they hiked again. And now the market's saying, well, what are they going to do at this meeting? We've got expectations from the analysis. About 2/3 expect a hold from the RBA this week, and the rest expect a 10% hike. So about the other third.
Sorry, a 10% hike?
A 10% hike, so a 25 pip hike.
Now that would be interesting, wouldn't it?
Yeah. It's Turkey we're talking about now, aren't we? So the others are talking about, or the 10, should I say, economists, because there's about 30 that were polled here, think they're going to hike by 25. But both camps think there's potentially going to be further hikes coming as well. So even these ones who are looking for a hold say they're going to hike later on. Rate probabilities are a bit closer. We're pricing a 55% chance of a hold and a 45% chance of a 25 pip hike. But it seems we're getting into that part of the cycle where really no one has a clue what central banks are going to do. That's going to bring more volatility around these central bank meetings, because we don't know, we've got two outcomes. Are they going to hike? Are they going to hold? Explicit forward guidance, the likes of which we've got from the ECB, has been thrown out the window. No one wants to put their head on the block, if you like, and say, yes, we're going to hike 2 more times over the next 2 meetings. So for us traders, it's going to be choppy. It's going to bring a lot of volatility. We've got to be careful of that. But in terms of what happens at these announcements, it's pretty much a coin flip.
Yeah, absolutely. I mean, you say markets don't have much idea of what's going to happen. I don't think the central bankers themselves have much idea of what's going to happen either, in all honesty. I think the other interesting point with the RBA in particular is that Philip Lowe, the governor of the RBA, his term expires in, I think, mid-September or mid-October. Now, I'm sure someone will correct me if I've got that wrong. But it does just throw another interesting dynamic in there, because oftentimes you see, as central bankers come to the end of their terms, they kind of leave things on hold and they pause, and they don't really want to hand any sort of pre-commitments in terms of policy over to their successors. And I just wonder whether that may perhaps mean that the RBA, perhaps they hike this week, but I think, as you say rightly, forward guidance is likely to be very, very limited, very, very bare bones over the next 2 or 3 months, because Lowe is not going to want to try and sort of handcuff his successor to a predetermined policy path. So again, that just creates more uncertainty in terms of market pricing, more volatility to be priced into the Aussie dollar over that period. And actually, the Aussie did okay last week. I think we may have a chart on that a bit later on. We're back in the range that we've traded for some time. So things are certainly looking a little bit more interesting down under than in some other markets, perhaps.
Yeah, definitely. I'm not sure if Lowe's got the option to continue as well. I'm not. I don't know if they've decided.
Well, I think there is the option, but judging from the Australians that I talk to, and also the reception that Lowe has got in the media down in Australia, I think there's more chance of me getting the job than him getting a second term. In all honesty.
You probably couldn't do a lot worse.
Well, no, I'm not sure that's a compliment, to be honest. So,
no, I said you probably couldn't do a lot better. But
well, yeah, that's more accurate. In that case, let's move on. We're talking to job vacancies, so let's talk about jobs. The US labour market report, which I mentioned in the intro, out on Friday afternoon, that just gone. Headline payrolls very, very strong once more. 339,000 jobs added to the US economy in the month of May. That is the 14th straight beat compared to the Bloomberg consensus, at the very least, which sounds great, but to me it screams, why the hell have economists not revised their models yet if they've got it wrong 14 times in a row? Not that I can claim to have got it right, but there we are. So there's clearly no sign of softness when you look at the headline non-farm payrolls number, and actually when you dig into it, and in terms of the sectors and the changes in employment in the sectors over the month of May, it was only really the tech sector that saw major job losses, which, to be honest, we all knew about anecdotally. There's been a lot of layoff news there. A small decline in manufacturing, not too much to worry about. It was so small, it could have been a rounding error. And actually every other sector recorded an employment gain. So very, very solid there. The earnings component was okay as well. Earnings growth did cool just a little bit to 1/3 month on month, but to be honest, that's probably good news. Again, it's that kind of Goldilocks pace of earnings growth where it's quick enough that it's going to keep people happy, but it's not too quick to cause a kind of wage price inflationary spiral. The big kind of red flag from the payrolls number, from the employment report, forgive me, is the unemployment rate rising 0.3% to 3.7% in May. That's the highest since last October. And that's despite participation holding steady at 62.6%. Now, there's two reasons why unemployment can rise in terms of the unemployment rate. Either it's because more people are coming in to look for a job, entering the labour force, or it's because people are losing their jobs. Now, it can't be in this case because more people are coming in to the labour force to look for jobs, because participation doesn't tell you that. So you then ask, well, how can the US economy add basically 300,000 jobs and unemployment rise? Well, this is because of the way the data is calculated and collated. The non-farm payrolls number and the earnings print come from something called the establishment survey, which unsurprisingly involves surveying establishments, i.e. businesses. The unemployment rate comes from the household survey, which again, unsurprisingly, involves surveying households, going around to people and asking, are you in a job? Are you looking for work, et cetera, et cetera. Now, the household survey is very, very noisy. You can actually go on to something like TradingView or Fred from the St. Louis Fed or a Bloomberg terminal, if you have one, of course, and plot the household survey employment change against the establishment one. And the household survey is an absolute mess. And it's interesting that the only time it gets attention is when it's bad news, when there's something bearish in it. When the unemployment rate is printing cycle lows, no one wants to talk about the divergence between the two different surveys. It's boring. So I think we should probably ignore it and consider it noise in the when it's bad news as well. Interestingly, job openings, the JOLTS data was very, very strong again. The PMIs pointed to pretty strong employment figures as well. So I think there's something for everyone in the data in terms of payrolls, but actually for me, the jobs market in the US remains incredibly and surprisingly resilient. And interestingly, and I want to get your thoughts on this, Ryan, equities rallied on good news, which is something we haven't seen for a while. I wonder whether that can continue.
Yeah, well, I think that's something we've been looking for all year. Has there been a switch in the risk trade and how that works? So it's been no surprise to see equities rallying on good news. In terms of the jobs numbers, the unemployment number was, a little bit of a eyebrow raiser. I had a thought at the time, maybe it's because we're seeing now some of these tech layoffs actually becoming redundancies and actually people being let go. Because we look at the Challenger Grey numbers that come out just before, and they're an intention to let people go. They're not at that point, that many people have been let go. So it's something that happens maybe in the months ahead, and maybe some of that has taken time to filter through. You know, obviously it's been in the tech sector, as you say. So you can have jobs gaining in one sector and losses in the other. But it's a bit of a mess between the surveys. It doesn't really matter. That's what the Fed are going to look at. They're going to look and see a 3.7% unemployment rate. That's what they're going to focus on at the next FOMC. But is it the final crack starting to show in the jobs market? Are we going to start to see some numbers coming down, the headline numbers dropping once again? But for now, you've got to say that the jobs market remains strong. That's a green tick for the Fed itself. Now, if they get inflation coming the right way, then again, that's the second green tick they want, and then they can look to pause on hikes. But for me, it's still about the inflation number. Jobs gets a secondary glance these days.
Yeah, absolutely. I mean, the Fed aren't quite the single mandate central bank they were last year in terms of focusing on inflation, but it is still, I would say 70-75% of what they're focusing on right now. Just on the unemployment rate and how that impacts the Fed, I think it's important not just to look at the absolute level of unemployment and the change in unemployment on a monthly or a quarterly basis. But we also need to look at this relative to the Fed's forecasts. Now, we get another set of forecasts from the Fed next week, and I wouldn't expect too much change to the last set that we had in March, in all honesty. And those forecasts in March had the unemployment rate at year end of 4.5%. So actually, the Fed are expecting the labour market to soften. They've already told us that, and that is what they are making policy based upon those forecasts and those assumptions. So you could argue that unemployment at 3.7% is, well, certainly by historical standards, it still represents somewhere near full employment, but also relative to what the Fed are expecting to happen by year end, we're probably on about the path that they were expecting us to be on.
Yeah, it gives them a bit of room, obviously. They've warned that the jobs market may have to take a hit as they try and control inflation. But as I say, at the moment they've got a green tick because inflation's coming down and the jobs market is still strong. They would rather it doesn't collapse just to get inflation down, as part of their policy. So it's going the right way for them. Now, what might be the shock is we get inflation coming down to 3-4%. Everything's going tickety-boo, and then we see the jobs market collapse, and then we're in a right old mess.
Yeah, that would be fun, wouldn't it? Almost as fun as the next thing that you're going to talk about, which I've just noticed.
Yeah, well,
why are you doing this to me, honestly?
Because you love it. You love it. You love it. Because, just when you thought it was safe to move on from the debt stuff, we really have to pay some attention to the upcoming, the market worry warts, who are all getting a little bit antsy about what's going to happen now. We're over the debt ceiling hump. What's going to happen with liquidity, with bonds and everything. And the market right now is worried that the government's going to have to undertake large-scale debt issuance, to refill the spending tanks, all this money that they've been blowing out the TGA since January. And it's worried about liquidity. It's worried about pressure on bank reserves. Because the market wants to see how much the Treasury is going to have to raise on top of what it needs for its normal borrowing costs. Now, we've had a little bit of an inclination about that. Last week, we had some headlines out from the Treasury. They delayed a 3 and 6 month bill auction. There's going to be further details coming today. But they actually announced that they were upping both of those by $2 billion. So I think it was 65 billion they were looking at for the 3 month, and 58 billion, I think it was, for the 6 months. So up about 2 billion each. That was interesting because it shows they're going to take a slow and steady approach to this. They're not ramping it up 10%, 20% for these auctions. They've got, roughly 18 months to refill the coffers, if you like. That's not a huge uplift in issuance. And, we've got 10 years, I think there's about 15, 16 different 10 years of bonds that they sell every month. So, 2 billion here, a billion there, a couple of billion here. Over the course of the next 18 months, he's going to get them, up to their 500 to 700 billion level that they like to keep in this account. And so I think the market perhaps is maybe getting a little bit too cautious about things. It's getting, as it likes to do, overly worried that, there's going to be problems with reserves. There's going to be problems with liquidity, dollar shortages. We've heard it all before. For us trading it, we need to know about that, because if the market goes too far one way, gets too extreme in its fear about something, that impacts the market. That potentially becomes an opportunity for us to trade. If dollar starts to get pressured or dollar starts ramping high on the liquidity issue. But the Fed have got the tools to combat this, and they've already mentioned, QT is a big one. They can help the Treasury out by slowing or stopping QT just to keep that liquidity in the pipe. We've got the reverse repo. So there's plenty of tools for officials to use so that we don't have problems. But that may not stop the market getting a bit antsy about it.
No, definitely. It's also something that the sell side are talking up a hell of a lot at the moment. I mean, the number of pieces you see in terms of TGA, rebuild, liquidity drain, yada, yada, yada. I mean, I'm almost as bored of that as I am of the debt ceiling itself at this point. I think, a few things I would say. I think in terms of a trading standpoint, if we do see market moves that you can clearly pin on concerns around this very issue of liquidity coming out as the TGA is rebuilt, I think they are probably there to fade, i.e. if equities fall or if the dollar rallies significantly on those concerns. I think they are there to push against. The only caveat to that would be in terms of the banks. I think the big difference in terms of the TGA rebuild and the increase in issuance this time compared to what we've seen in the past is that we know regional banks, particularly in the US, are on much shakier footing, shall we say, to put it politely, than they perhaps have been in the past. And if we were to see a big fall in reserves, then that obviously could have an impact there. And I think just lastly on this, I think, the bar for the Fed to change their plans with regards to quantitative tightening is quite a high one. I think if we were to see any issues occur in terms of funding, in terms of reserves, it would be things like the overnight repo operations, that kind of thing, that the Fed would probably look to do first, rather than slowing or halting the rundown of their balance sheet. Because if they were to do that, no matter how much they try not to, it is going to be seen as a monetary policy action by the market rather than a market function reaction. And I think that's a distinction that the FOMC will be very, very keen to draw. Now, we obviously saw with the Bank of England just down the road last year, where they stepped in with some temporary gilt purchases to try and stabilize the market. Could we see the Fed do something similar? Perhaps, but I think it's a long shot in my view.
Yeah, I think it's a long shot too. But I think for this meeting, I think we should be on watch for some comments, just even if they're off the cuff comments, to say that if there are any problems, we've got it covered, that sort of thing. But as I said, if the market gets too extreme about it and trades it, then like you say, that's a potential opportunity to fade.
Absolutely. And there will certainly be at least one question to Mr. Powell about that next week, I'm sure. Well, with that segment over, let's get on to some charts. So what do I want to look at first? I want to look at the S&P 500 once again. It feels like I talk about this probably once a fortnight at this point, but it is the world's primary equity index, so it'd be rude not to talk about it, particularly after the impressive gains that we had last week. It was another strong week for the US equity market, and actually, interestingly, particularly on Friday, when we saw that big gain, as you can see from the candle there, around about 1.5% on the S&P after the non-farm payrolls number, it was actually value. It was actually those stocks that are really exposed and levered to what you'd call the real economy that outperformed on Friday. The Russell 2000 had a really, really impressive trading session on Friday. So everyone who's been harping on around, oh, the breadth is too narrow, tech is the only thing powering the market higher, blah, blah, blah. Well, stick that one in your pipe. Anyway, we had quite a nice closing break of 4,200 towards the tail end of the week before. We finally managed to significantly motor higher, and we now look to further upside resistance. We're already at the highest levels since August. The August high comes in at 43.25. It looks like the market could be gunning for that at the moment. And then, of course, above, if we were to really stretch higher, you've got 4,400, which was was the level that we had in kind of February, March, April of 2022 before the market had this big move lower. The other thing that I think is important when we look at equities, and if you haven't worked out by this point, I would still be long equities and buying any dips that do occur. The other thing that's important on Friday, at least, is the VIX. The VIX closed below 15 on Friday for the first time in well over 3 years. I think the first time since February of 2020, which was before the pandemic began, of course. And as I've said many times, the VIX coming lower, it means that institutional investors can increase their exposure to equities, that the risk-weighted exposure there can be increased. And it makes playing stocks from the short side very, very hard to justify in my mind. So in a week which is relatively quiet for US economic data, in a week which is going to have no Fed speakers because we're in the blackout period, I think the path of least resistance continues to lead us higher here.
Yeah, I think I agree with you. I think a lot of the market was waiting to see, obviously, the end of the debt situation. That's been a bit of a green light as well. And the question is going to be, can it hold this rally? Can it hold this break? You know, we've been in this range, 38s to 41s, 42s for quite some time. Can it hold this break now it's made it? Your levels are down at 42, 00, 10, 15, that sort of area. If we test that and hold that, then the upside's beckoning, and we'll probably get a move on those 43.25 highs that you've highlighted there. So, as we like to say, go with the flow.
Absolutely. Why fight it? Speaking of the debt ceiling, you want to look at the Treasury market, I believe.
Yeah, I want to look at US 10-year yields because I've been watching this pretty closely. I've been waiting to see what the final reaction in yields would be to the debt resolution. I wanted to see what happened down at this 3.6% area. Now, I was expecting perhaps a test there, some of the risk premium, if you like, coming out from the debt stuff after that got resolved. We stuck a toe in the water just below that 3.6 level, but then we've bounced since, and we've held it previously since then. We've had a nice little move up. And for me, the last reaction was the market trading out that event risk and moving back to trading the fundamentals and obviously their effects on monetary policy expectations. I think this could be an important hold at 3.6% for trading the higher for longer part of the Fed trade. Now, of course, a big breakdown in data and inflation, and will put the pressure back on. But I want to watch to how this reacts for any sort of modest data. Any mild changes to the data points. Are we going to see further downside, or is it going to hold this area here? Because it's important to remember that the Fed are obviously going to want to get rates down at some point. Everyone, talks about this neutral level where central banks want to get to somewhere maybe 2 to 3%. So if we're up at 5% now, we're looking at 200, 250 basis points of cuts. You're going to see that reflected more in the longer end than you are in the shorter end for the higher for longer trade for that one. But I don't think it's crossed the market's mind to think that maybe the neutral rate may have to go a bit higher than the Fed or other central banks expect. If inflation, comes down to maybe 4 or 5% and holds at that sort of level, we might need to price in a higher neutral rate, which is going to mean less cuts potentially from the central banks. And one of the areas you're going to see that reflective is here in 10-year yields. But I don't think the market's even thinking about that prospect at the moment.
No, I don't think it is either. There's a couple of things I've mentioned here. The first thing is if you look at the yield curve, particularly the 2s, 10s, which is probably the most watched yield curve spread, it has the curve has deepened its inversion for 4 weeks in a row now. I think we're back at minus 81, minus 82 basis points or so. So it's clear that the market, if you look at the curve at least, seems to be getting a little bit worried about concerns over a growth slowdown once more. I would question at this point, I think the 2s, 10s has been inverted for about 18 months. At what point does this kind of invalidate its supposed predictive power of a recession, given that it seems to have been inverted for quite some time? But anyway, that's probably a conversation for another day. Your point on the neutral rate, I agree with. I think it probably is a little bit higher than it was before the pandemic, although interestingly, I think the New York Fed had a bit of research out over probably a couple of weeks ago now, saying that they don't think the neutral rate has moved compared to where it was before COVID, which shows how much of a guessing game all of this is. It's tricky enough to work out neutral, which is what we would call R star, but there's something else, and I really don't want to get all geeky in terms of monetary policy here, but I'm going to. There's something else that has started to enter the vernacular over the last 6 months or so, which is something called R double star. Now, when we think of neutral in terms of R star, we think about the rate at which the economy is in equilibrium. You've got inflation bubbling along, pretty much full employment, growth is doing okay. R double star is the financial stability neutral rate, and that is where we would consider the rate to be basically a neutral rate at which banks can do okay and survive. Now, R double star seems like it's a hell of a lot lower than R star in terms of the neutral rate, given the regional banking issues that we've had in the US. And I wonder whether that is another consideration that particularly fixed income traders need to have on their minds, because if you do see a resurgence of those banking issues, which seem to have gone away for now, and we hope that they've been put to bed definitively, that is definitely something worth having on the radar, I think.
Yeah, and now you've brought it up, you're going to become the expert on that. So if I have any questions, I'm going to throw them at you, mate.
Well, there we go. I'm off to go and read some monetary policy research.
You better get Googling.
Oh, well, I was going to say, it'd be more interesting than the debt ceiling. Right, we're going to get very loony heavy here, and I'm not talking about the hosts, I'm talking about the Canadian dollar. I want to talk about dollar CAD first of all, and hopefully I don't steal Ryan's thunder with what I'm about to say here. But the reason I wanted to bring up the Canadian dollar, and let me just clarify, I did my charts first, so I called this one. I wanted to bring up the Canadian dollar because we do have the Bank of Canada on Wednesday this week, and it is very much a live meeting from the BoC on Wednesday afternoon. Economists are expecting rates to remain unchanged at 4.5%. The market, however, sees about a 45% chance of the BoC raising rates, and I would argue that that's probably underpriced. I think there's a very strong chance that the BoC do move again. They've been on pause since January. Since then, the Canadian economy has been doing very, very well. Growth has been very solid. We had a decent upside surprise on the Q1 GDP number a week or two ago. We've also had a re-acceleration in inflation, which is obviously concerning, particularly if you look at the core measures. And the jobs market is still very, very tight, albeit we get renewed jobs data from Canada on Friday, which comes after the BoC's next decision. So I think there's a decent chance that they move again in terms of a rate hike, and it could be a situation like we saw with the RBA, where it's not a kind of one and done move, it's a hike and here's our tightening bias coming back once again. But even if they don't do that, if they do hold rates, I think it's going to be a very, and I hate the word, but I think it's going to be a hawkish hold from the BoC. So I do think, for me at least, risks to the Canadian dollar are to the upside this week. For dollar CAD, that would be to the downside. 133 is the key level to watch if we do see a move lower in the pair. That's obviously been the low for some time now, since the middle of April. The range low, the range that we've been in for 6 or 7 months now, comes at 132.25, which is perhaps a little bit punchy to expect this week. But if we do get a hike, then perhaps we could test that level. But for me, at least, I think I would be looking for the CAD to rally this week. And we've got that really, really key resistance above at 135.10, 135.20, where all of those moving averages are converging. And if we do stay below that, then I think the Canadian dollar has room to run to the upside. Ryan, do you want to comment on this, or do you want to move straight on to EURCAD?
No, I'll have a quick comment on this, if that's okay. I'm disappointed you haven't got the trend lines in, because if you chuck some trend lines in off those two big highs and again off the lows, you'll see that they come in on the downside, at least, come in right around that 133 level as well. And it's been a bit of a good technical picture to trade on that side. But I'm on the same side as you. I think and I've thought for a while now that perhaps the Bank of Canada are going to have to maybe turn a little bit more hawkish based on the data that's been coming out. So I think we could see the downside if they're hawkish. I mean, that 133 from here is more than doable. Even that 132.55, if we get something really hawkish, it can be quite volatile, the loonie. So I wouldn't rule out a move down there on a hawkish note. Could they hike this month? I don't think so, but I think they could, as you say, give us maybe a bit of a heads up that one might be in the pipe. That's potentially going to keep some downside pressure on CAD for a while on that one. And obviously we've got whatever's going on in oil. We've got this OPEC stuff over the weekend, which has seen a little bit of a gap up. I think they wanted more, but that's what they've got. That's also a bit of a boom for CAD as well. But it's been on and off the oil bus the last week or so. You know, you look at it one day, it's on, you look another day and it's off. So the oil trade to CAD relationship is a little bit flaky at the moment. But in the main, the downside is really possible. And that's another one I'm going to look at for EURCAD.
Yeah, exactly. Just before we get on to that, I just one final point. I think this emphasizes what we've been saying for a while now around why it's important to look at monetary policy decisions compared to market expectations rather than just looking at them in isolation. Because if you looked at it in isolation and went, oh, the BOC have held rates, you kind of go, well, okay, we were expecting them to do that. Well, actually, the market isn't expecting them to do that. There's a real non-negligible chance in terms of the market's view that they do raise rates. And if you are trading around any policy decision, not just the BOC, it's of course very, very important to be aware of that. What about EURCAD? A bit of a different perspective on the same idea.
Yeah, well, this is, as I said in the title, it's the same eggs but a different basket. And we're keeping the CAD theme because it's just a reminder there's always more than one way to skin a cat when you're trading. And if you want to get away from the dollar side of the trade, you can look at something else. And perhaps EURCAD is one to look at because it's been playing really nicely with the techs. Last week, we held the long-standing 46, 40, 50 area. You can see on the chart the thick red line there, really been a big, strong line when we've tested it. And it's been downhill since. Now, we have a really juicy-looking one-month double bottom around 42.40, 42.50, which is also the 38.2 fib of the August 2022 rally. And this pair may be a bit cleaner to trade the CAD in, given the uncertainty, as mentioned, around the Fed, which obviously means uncertainty around what the dollar is going to do. But also given what we expect from the ECB, which we have a bit more certainty that maybe we've got 1, 2, possibly 3 more hikes in the pipe, which gives us a bit of certainty for the euro. We also have the 200 daily moving average moving up there nicely to that double bottom there. So, if we do get a hawkish Bank of Canada, this is one, if we get down to that area, maybe where the price is going to run into trouble, maybe look for a little counter trade on that one, because obviously the ECB is still in the mix on that one too.
Yeah, definitely. And actually, I'm glad you mentioned the ECB because it seems like the market's kind of coming around to a bit of a consensus that they go in June 25, of course, they go in July, another 25, and then probably that's it, with maybe a bit of a concession on QT and the balance sheet rundown in September while keeping rates unchanged to appease the hawks. So, I mean, as you say, the euro has started to look quite toppy across the board. Actually, you look at EURCAD, euro dollar, no matter where you look, there are signs that the common currency is starting to roll over. And if the market does begin to price that the ECB are going to be on hold, as someone like the BoC or even the RBA resume their tightening cycles, then we're back to that good old monetary policy divergence for us to play on again.
Yeah, very much so. I mean, in that situation, then you're probably looking at more downside for EURCAD if you get a hawkish BoC and a less hawkish ECB. But we pretty much know what's coming. I think the September issue is a little bit up in the air with those. But yeah, play between the meetings, and that's what we do with these trading. If you get a hawkish, as I say, hawkish Bank of Canada, then maybe that's something to run longs off that level if it holds into the ECB, see what happens there.
Definitely. It's certainly going to be a busy, 8 days, 9 days, if we include the RBA, of central bank meetings. Before we get to that, though, let's have a look at our plays of the day. So I want to look at the dollar this week. I know that the dollar index has its detractors, and actually I'm perhaps just being a little bit lazy or using this for simplicity's sake to show the direction of the dollar and where we are. Of course, you can play this through various individual currency pairs if you wanted to, and I'll get onto that in a second. But the dollar was lower last week, for the first week in 4, and a little bit perplexing, really, given that the market continued to reprice its Fed outlook in a more hawkish direction. So I just wonder whether there's perhaps a little bit of profit taking when we got to that 104.50 level. Of course, it was also month end last week in the early part of the week, so that may have had a bit of an impact as well. But to be honest, I don't really care what the reason for it was. I'm bullish on the dollar, and actually the dip that we've seen is a dip that I will be looking to buy, particularly with the dollar index having held on to this 103.50 level after the payrolls number on Friday and closing north of 104 and opening there again in Asian trade. So I'd be looking to be long the dollar. I do think that 104.50 high is going to be taken out at some point. And I think this really is very similar to the case I made in terms of equities. It's a quiet week. There's not really a lot going on. The market's probably going to take the path of least resistance, follow the trend that's been in place for some time. And that has been for the dollar to continue moving higher. And I think that will probably continue this week. As I said, you can either play it through the dollar index, as I have done here. You can look at specific currencies. We looked at dollar CAD earlier, which is bucking that trend slightly because of the BOC we would expect. But you can look at cable. I like short cable if we get back below the 50-day moving average, which is around 124.50, 124.55. And if euro dollar can make a closing break of 107 or below 107, then I'd be looking to get short there as well. But for simplicity's sake, I will be long the dollar index this week. Mr. Littlestone, what are you looking at?
Yeah, I'm looking at euro sterling for this one, and looking at longs down into maybe sort of 85 handle, 84.80, a level I've got down there. I'm hoping this one goes a bit better than my euro knock last week. That one went the right way in the end, but not before going the wrong way too far for my pockets. But that's a reminder that we can be right with a trade, but the market wants us to be wrong first. So this one hopefully comes good. So Eurostone, we know it's been falling on expectations, rising expectations for the BOE to hike rates more than they expected. No shock to me, of course, as many viewers of this show will know over time.
Yeah, haven't you?
But we're potentially heading towards an area where I'll start to think that things are getting fully priced, and maybe we see a little bit of a extreme push through in that pricing. We've got a bit of a level down here, sort of 85.70 down to 50, which we held last week on a first touch. I'm not sure we're done with the downside just yet. We need to watch some of the data points and those expectations for the central banks. But if we break through that 85.50 area, we're likely to test my buy zone. And if I get in, I won't be looking for a massive reaction in the first instance, a massive move back up. But I certainly think if we get down and touch that point down in the low 85s into 85, I think a bounce to 86 is achievable. But I'll look to do what I always do. If I get in a trade, I'll look to do the slice and dice method, just taking partial profits if the price goes back my way and if the market allows, and then that'll give me the leeway to let the trade run as far as it wants to go. You don't need to be big with a stop on this one, anywhere below maybe even 84.70, 84.60 if you want to push it, and that's where you're wrong. If we get a move down here, that is, and let's see what happens.
Indeed. Excuse me. Good stuff. I'm glad at the end of the show. I was going to say, I'm not sure I'm going to make it to the end of the show at this rate. So that does bring us to the end of this week's trade-off. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining us. Thank you, as always, as well to our producer, Kyriakos, for bringing this together as brilliantly as he always does. At this rate, he might be hosting next week, given where my voice seems to be going. It is a busy week of central bank decisions. It's an even busier week next week with the Fed, the ECB, and the US CPI print on deck. And we will be back then with another episode of The Trade-Off. If you've enjoyed the video, please leave a like, drop a comment as well. Let us know how you're trading the markets, and we'll see you again in a week's time. Thanks as always for watching, and goodbye for now.